Good morning, everyone. This is Shauna, the tax goddess, and I want to talk about what the IRS considers a tax shelter. Now, there are thousands of things that the IRS considers a tax shelter, and I'm using, in today's video, I'm using the term tax shelter as something bad, okay? Now, you guys know that what I do for a living is tax strategy, right? We help people reduce their taxes using legal tax shelters. But today we are going to be talking about the bad version of tax shelters, okay? When something is too good to be true, according to the IRS. Now, I'm going to use two examples today, two very famous examples, but the theory behind this can apply to almost any strategy that somebody approaches you about. So today we are going to be talking, actually, I think I'm going to do three. Let's cover three today, okay? Today, I'm going to be talking about not only captive insurance, and I have some great news for you guys about captive insurance. So we're going to cover captive insurance, we're going to cover conservation easements, and we are going to cover Dubai, which is a big, everybody's doing the Dubai thing, okay? So first things first, I want to lay some ground rules here for what we're discussing. Every single strategy, not every, I can't say every single, 99% of strategies have a good version and a bad version, okay? So we're gonna go through the good version and the bad version of each of these strategies, okay? So the good version is it exists, it's legal, it's above board, it's been pre-approved by the IRS, okay? The bad version is the same strategy, but somebody tweaked something. Somebody caused an issue with something. They're doing something that is not according to what the IRS approved, okay? And that's what makes it bad. That is what causes problems, all right? So let's talk about captive insurance, all right? Now, this is a big one. The IRS is promoting, pumping media. We're coming after people. We're looking for people, right? But what they're saying, when you actually read the notices, what they're saying is we're going after people that aren't doing it right. They're not reporting it right. They're not using it for real risk. Okay, so let me back up. What is captive? Now, we have other videos on the subject, so I'm just going to give a brief overview today. Captive insurance companies are an insurance company that you form, that you pay your own money, your own insurance premium money to, but you own the insurance company. Okay. Now, and you get tax deductions. They're big, huge, amazing tax deductions for captives, okay? If you're looking for another video on that, search our YouTube channel for captive 831B. You will find a very in-detail video on it, okay? Now, the good kind of captive works with risk that is real, okay? So, for example, if you're a business owner and you are running a company and something happens to you, okay, and the company needs cash to be able to run the business because you're out sick in the hospital for a year, something happens, okay? That is what is called key man insurance. That's a very real risk. I could go out grocery shopping today and get into a car accident and I might be in the hospital for a year, okay? That's a very, very real risk, okay? Now, that's a good kind of insurance, okay? It's a valid risk. It's absolutely above board, okay? That is a real thing that happens in businesses all the time. Maybe it's not you, maybe it's your second in command. Maybe it's your head of sales, right? It really doesn't matter, okay? So those are all good examples of when a captive insurance program is good. It is insuring a real risk. Bad, and my favorite example from the IRS, this was actually a court case. You had a rancher that had 5,000 head of cattle. They were up on top of a mesa, and a mesa is a mountain with a flat top, okay? So they're all sitting up on top of this mesa, okay? He got flood insurance to protect his cattle. The quote from the court case, the IRS basically said, unless there's a biblical level flood, you are not going to need insurance on top of a mesa, okay? So that was a bad example. That was somebody trying to use the captive, use the way it's structured to get a tax deduction for something that is not real. It's not a real, ordinary, necessary, and therefore valid business expense, okay? So you got the good version of captive, the bad version of captive. We see the same thing with conservation easements, okay? Good version, an example that I actually participated in, all right? Had a client, they owned a property, it was sitting on the side of a hill. Well, the hill itself was part of a conservancy for nature, right? For birds and all sorts of nature type things, okay? they were able to donate and do a conservation easement of the back half of their property. They were able to get a little over $1 million contribution for that. And while they lived in the home, they were still eligible to use the property, right? To hike up the side of the mountain, these kinds of things. Okay, that is a very valid, completely normal type of conservation easement. The bad kind is when somebody approaches you, and this is what we're seeing a lot of, right? This is the one that's on the dirty dozen. These bad ones are always the ones on the dirty dozen, IRS dirty dozen list, okay? The bad version of a conservation easement is you don't own the property. You buy into a partnership for $100,000, and the partnership is going to give you this donation value of, let's say, $500,000. The IRS doesn't like that, okay? You're getting more than what you put in. Now, be very careful here. There's some really, really slick salespeople. I have only ever seen one conservation easement where the value was more than the amount you put in, and it was only about 2 times, not 5 times. I've seen 10 times. I've seen some really slick salespeople. Please be careful about this one, okay? Please run it past your CPA, run it past your tax strategy team, okay, to make sure that you are using a valid, the good kind of conservation easement, not the bad kind of conservation easement, okay? Now, the third example that I want to talk about here is Dubai, okay? I have seen article after video after YouTube video, everything, right? Talking about all you have to do is show up in Dubai for 1 day, set up a business, run all your money through it, show up in Dubai for 1 day, and you will pay a maximum of 10% tax. Okay, does it sound too good to be true? It is, okay? There is not a way to do that unless you are literally giving your money away. So it is potentially a valid strategy, but you have to give your money away, completely give your money away, okay? The only way to do something like that and get the beautiful 0 or 10% tax rate in Dubai, you have to live there. You have to be there. Dubai has to be your closest connection. So you can't be living in the US, having your kids go to school and going to church and doing donations, and this is where you get your mail in the US, and get the Dubai tax rates. It doesn't work like that, okay? So guys, I want to warn you, and that's really the purpose of this video, okay? If something sounds too good to be true, there are a couple of things that I want you to do, okay? The first one, reach out to your tax strategist, okay? We see all of these things. Everybody approaches us, right, to get our clients to do this strategy. I've seen the good, I've seen the bad, I've seen the really ugly, okay? So step one, if you're looking at one of these things and your brain says, oh, that sounds amazing, why doesn't everybody do this? There's a reason why everybody doesn't do that, okay? So reach out to your tax strategist. Let's vet the thing. Let's make sure, do we have private letter rulings? If a strategy has a private letter ruling, PLR, and the strategy is following the details of the PLR, okay, then the strategy is valid. PLR comes from the IRS. That's the IRS stamp of truth, okay, that they've approved it. So a PLR is a good thing, but we have seen, remember those bad people? We've seen companies that get a PLR with a set of facts and circumstances, let's say 10 facts and circumstances. When they actually implement the strategy, they only do 9 out of 10 steps, which means the PLR is now invalid, okay? So step one, reach out to your tax strategy team, okay? And if you don't have a tax strategy team, call us, taxgoddess.com, okay? Typically, the people looking for this level of strategy, captive conservation easements, moving to Dubai, these kinds of things are typically paying significant amount of taxes anyway. We would be happy and would love to look at your entire situation. So book a call with the team. We'll take a look at everything, okay? So step one, reach out to your tax strategist. Step two, reach out to your CPA. Now you'll notice they are number 2. Often CPAs are even more, significantly more conservative than a tax strategist. You guys have heard me talk about that aggression scale, 0 to 10. Typically, tax strategists are like a level 8, right? Totally legal, but we're not going to jail. Most CPAs are like a level 2, okay? So I do want you to run it past your CPA, but we want to know if they've heard anything. Have they seen this? Have they worked on this before, right? What kind of impact if you do this strategy? So let's say you decide, Shauna, I'm not sure if it's good or bad, but I'm a level 8. I'm going to take that risk. And so you do that strategy. We need your CPA to calculate what impact is that strategy going to have on your bottom line, okay? So we definitely want to look at that as well with your CPA. And of course, we want you, actually, your spouse should probably be number one. Tax strategy should be number two. Your CPA should be number three, okay? When you make decisions like this, it does impact the entire family. It's not just you, right? If you're married, it's also going to impact your joint filing tax return. Your spouse needs to understand it. They need to know what's going on because they are going to be signing that tax return as well, okay? So guys, as you can tell, this is exactly what we do here at Tax Strategy, and I love educating, and I want to make sure that you guys are doing everything above board, crossing the T's, dotting the I's, like I said, level 8, taking all the strategies, but if the IRS ever came to ask, you've got all the backup and all the proof. So in the meantime, if you have any questions, if you're looking for a tax strategy, if you are paying more than $100,000 a year in tax, if that's your tax liability between federal, state, and self-employment tax, and your CPA has not brought up captive conservation easements or Dubai, Ireland, Puerto Rico, something like that, we would love to help you, okay? This is what we do. Most CPAs just don't even look at this kind of stuff. They don't have time, right? They're focused on filing tax returns, not on bringing tax strategy. So if you have any questions or if you are looking for some tax strategy in your life, we would love to become your new tax strategy team. Reach out to taxgoddess.com and you can book a call with my team. They'll gather some data and then let's see what we can do to help you save your own version of millions. So have a wonderful day, everyone, and we'll talk to you later. Okay, bye.